Okay, welcome back everyone to another episode of the Market Playbook. My name is Tony Zhang. I'm the Chief Strategy Officer here at OptionsPlay, and I'm joined with me once again with Jessica Inskip, our Director of Education and Product. Jessica, first of all, welcome back.
Thanks for having me, Tony.
Thank you for joining us. And today we're here to talk about something that is a big change here in the broader markets this week, which is the fact that on the back of the Fed meeting yesterday, markets have now re-entered bear market territory. So not only has it entered bear markets, but it also broke below what is a major support level of 3,900 yesterday. And that drastically changes our views in terms of positioning here in the broader markets and also the type of opportunities that we seek. So today what we're going to do is go through a beginner's guide to trading bear markets. Now, this is something that I think is going to be very important, not only from a strategic perspective, from a positioning perspective, but also to address what is likely going to be some emotional pain that most investors are going through. Just to keep things in perspective, the 3,900 level that I was referring to earlier, that is the level that the S&P was trading at in January of 2021. So we're talking about a year and 9 months or so where the equity markets have been trading above this level. So all the investors that have effectively bought into the S&P 500 above or after January of 2021 is now potentially underwater, at least potentially in some of your positions. And it's really important to think about how to position for it. And emotionally speaking, how do you deal with those losses? And that's some of the things we'll touch up on, from everything from position sizing to best practices for trading in these types of bear markets. So let's go ahead and get started. But before we do, what we are going to discuss today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we're going to discuss during today's session. So we're going to start off by just taking a look at the broader equity markets, talking about this bear market, what are some of the characteristics, and give you a sense for what should you expect in a bear market. And it's important to just understand the statistics, to understand what are the probabilities so that you can appropriately get yourself ready for understanding how to take bearish opportunities, because they are quite different. They're not just a mirror image of bullish opportunities. We'll talk a little bit about how to go about timing trades during a bear market and some of the checklists that I have put in place to help you identify potential bearish opportunities. And I'm going to show you some of the tools that are built into OptionsPlay that helps you find these types of opportunities and the option strategies that you can utilize to take advantage of the bearish markets. And then lastly, we'll talk a little bit about position sizing and scaling, which is important because in a bear market, things are quite different. It's more important than your strategy to make sure that you position correctly. But the primary thing that I want you to be able to walk away from today's session is a clear understanding as to how can I find bearish opportunities in this bear market. So let's go ahead and jump right into it. So let's first talk a little bit about where we are. Now, Jessica, you and I, we've spoken about this in terms of the Chairman Powell comments yesterday. And there's a lot of art, if you will, in dissecting Fed speak. So first of all, I'd love to hear your thoughts a little bit as far as, what did we hear from Chairman Powell yesterday that has driven the markets back into bear market territory?
Yeah, so it's an indication of restrictive policy, but it's restrictive for longer. And so even that tiny piece of hawkishness is what was needed to drive the markets down. And then additionally, though, he gave us the smallest sliver of hope of that they will have to be dovish at some point, but he pushed it out longer than anticipated. And remember, the market's forward-looking, so it takes on information as it's consumed and then corrects. And then there's that digestion period, which we experienced yesterday with that large volatility, and then really going down all the way to the bottom at the end. And then, of course, again today. And interestingly enough, if you remember that chart I sent back and forth between us of the S&P 500 when I pulled Jerome Powell on the chart and the market's reaction, the only time the market went down is 2 out of the 10 times total, now not including this. But this was more like the first time when it went down drastically. So it was very interesting that technical analysis and patterns and events proven to be true once more with even looking through it that lens.
Yeah, I did think that what was, I think, most interesting was that after the Fed announcement, markets actually rallied a bit And then it was only towards the end of the day when things had sold off pretty heavily. It was almost like investors were flip-flopping on the message as to what Chairman Powell was saying. And I think that, his message was really showing that the Fed doesn't really have a good sense for when they're going to be able to stop raising rates. As he said, we're going to keep doing it until the job is done. And markets did react to that. Fed, the bond market is now pricing in another 150 basis points by February. We were looking at 125 basis points before the meeting, so a little bit more hawkish, and that's why markets re-entered back into bear market territory. And as you can see, this is the chart of the S&P 500. This is a weekly chart. Relatively, and this is obviously from the COVID lows, big rally here, and now we've pulled back more than 20%, and that's what identifies a bear market. We're now about 21.5%, and notice how we've actually so far, this is as of Thursday's close, below the 150-week moving average. That's really the first time we've seen a close below that. We'll see if we manage to rally back above that by tomorrow. I suspect that's not going to happen, and that's really kind of where the tone of the market has really started to shift. Prior to this break of this support level of that 3,900 and the 150-week moving average, there was still some hope that we could play for bounces. And statistically speaking, markets were oversold. Playing for bounces statistically made more sense. But now that we've broken these key levels, that's really when things start to shift. And not only are we shifting our directional view, but also from a volatility perspective, things also change as well. We've already seen an increase in vol. This is the vol Q, which is the NASDAQ 100 volatility index. But if you use the VIX for the S&P 500, you see the same chart, effectively nearly double the implied volatility of the markets over the past month and a half. My expectation is that we can see further upside here, well into that 40 range on the VIX or the vol Q, regardless of which broader market index you generally tend to track. So those are some of the big changes that I see here from the broader markets. And I'd love to hear kind of from the audience here. Where do you see equity markets in 1 week? Do you see it higher, lower, or you don't know? I'd love to kind of get the sense for the audience here. We've been doing these polls pretty often. And last week we had about a 70% poll saying that they expected markets to be lower. So far, with about close to half of you responding, similar type numbers. 68% of you, 69% say lower, 16%, only 16% of you say higher, and 16% of you say say you don't know. Sorry, there we go. Whoops, how do I get my polls back? I just don't know what I did with my poll. Okay, here we go. There we go. 69% of you say lower, 14% of you say higher. I will say that is generally speaking a bit of a contrarian view, that so many of you are bearish. That tends to be more of a bullish view here. But last week, 70% of you said lower. You were right. Perhaps we'll see that same thing or same type of follow through here again. But we're going to talk about bear markets. We're going to talk about trading them, or some of the stats around them, and making sure you understand how to navigate them. So let's talk a little bit about bear market stats, because a lot of times we tend to think of bear markets as just the opposite of a bull market, right? But it's not quite the same. So first of all, just to define what a bear market is, it's when the market declines at least 20% from the peak. So from the January highs, we're down about 21%. That identifies us as a bear market. But it also is identified by significantly higher market volatility. And that's going to have a huge impact in terms of how you trade these types of strategies. We usually think of bear markets as buying put options, but when puts are really expensive, it may not make sense to buy puts. So that's really an important element to understand when you're thinking about bear markets. You think of call options when you're bullish, put options when you're bearish, not as simple as that. Second thing to remember, we think of bull markets as kind of equal in both sides, but again, that's not true. Markets trade higher 60% of the time. It doesn't matter whether you look at this on a daily basis, whether you look at on a weekly basis, 60% of the time, statistically speaking, markets move higher. Only 40% of the time do markets move lower. So statistically speaking, you already have a disadvantage trying to find bearish opportunities. That's why it's incredibly difficult to consistently be a short player in this particular market. That's why there are very few short hedge funds out there. Very few firms have the ability to truly do this time and time again, because the edge is just it's just not in your favor. Imagine trading something that you only have a 40% statistical chance of being right. It's much more difficult to do. But the one thing that is important to understand is that markets tend to sell off much faster than when they climb. We usually say that markets, take the elevator down and then take the escalator back up, meaning they fall much faster than they actually rise. And I think the chart here of the S&P 500 is a good example of this, right? We declined 33% in the matter of 5 or 6 weeks, and then we took how many months to get back to where we were before that? And arguably, this is one of the fastest rebounds we've seen in history. Most rebounds tend to be quite a bit slower. So what we tend to see is a lot longer to take that move back than to take that elevator to the downside. So it's really important to understand these stats before you embark on taking a look at some bearish opportunities. Some of you may have had experience trading bear markets during the dot-com boom or 2008, and some of you may be brand new to investing and have never seen a bear market. So it's really important to understand kind of the characteristics of each one. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. Perfect. Okay, and I see so many of you joining us, and I'm sure many of you are joining us from all over the world. So please feel free to type your name and where you're joining us from. If you are joining us, especially for the first time, would love to hear from everyone. Every time we do this, we tend to find new people from all over the world joining us. So first of all, welcome if this is your first time joining us here on Market Playbook here with Jessica and I. Let's talk a little about bear market timing. This is really where, Jess, you and I spend a lot of time finding opportunities here in this type of bear market. And it's not easy finding opportunities in the bear market, but one of the most important tenets, in my opinion, more important than anything else when you're looking at bearish opportunities, is that it's important to understand that when you're looking for ideas, you want to make sure that the risk to reward of a bearish opportunity makes sense. And when we think about it from that perspective, waiting for rallies to enter a bearish position is usually where you want to find the best possible opportunities. And that doesn't sound, it sounds counterintuitive, right? You want to look for stocks that have broken support and continue to move lower. Those are your best bearish opportunities. But statistically speaking, waiting for rallies and then entering them as shorts is where you have the best possible opportunity. And the reason for this is because when you have a rally and you enter a short position from here, it doesn't take the stock to move much higher before you can say, okay, I'm wrong on this trade. My directional view was wrong, and I can get out at a relatively small loss compared to what I can potentially make if the stock does go back down to the expected levels. So I'm just using Royal Caribbean here as an example here of a stock that has recently rallied and is starting to turn lower. And I think about this, the stock was trading around 47.5 today. If it rallied back up to about 52, 53, I would probably start reconsidering my trade and say, you know what, maybe this is not the right time for this. For whatever reason, my timing is off. And then if I'm right, what I can potentially make on that is double, triple what I'm risking. And that is the most important part when you're looking for these opportunities. When the statistical edge is skewed against you, you have to make sure that the risk reward is then skewed back in your favor in order to be profitable. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. Perfect. And Jess, I'll let you take the next one, which is technical indicators and support and resistance levels. Why are they so important for you in helping identify bearish opportunities in this type of market?
Yeah, the market's all supply and demand in every aspect whatsoever, and that's inclusive of support and resistance. So if you are looking at something like Royal Caribbean, that is absolutely something that is not going to do well in this type of environment because it's considered discretionary, and anything that's discretionary with those macro headwinds, when you have demand construction and no one can, you're cutting your spending, that's going to go down. So we know that from a fundamental perspective. That's when technical analysis is super helpful as far as timing. So like you said, so for support and resistance, if I'm at an area of resistance, that is a great time to enter into my bearish position because that is an area of supply that will push it down. And once it gets back to that demand level, maybe that's lower where it's finding its new value or new price point. But until I see key evidence of it breaking either one of those, I will position myself in the optimal moments, which are those areas of supply and demand, which is just another way of saying support and resistance. And furthermore, I think it's so important to say, the more that you see that level, just like you're depicting on the chart, that was a support level earlier in June. It broke that support level in mid-June. So now old support became new resistance, which is testing now, and that proves very well. And then the last I will add to support and resistance is something I heard from Carter Worth, and that's just that support and resistance is like a mattress. You can sink into it. It's not necessarily a fine line, which is absolutely true. I tend to draw zones on my support and resistance just to account for that movement. And is it going lower when it tests those support and resistance levels and that mattress feel? Just a great way of also explaining the way the cloud is support and resistance, if you will. But it's a great indication from timing and skewing risk reward in your favor. Just like you said, completely agree.
Yeah, and I'm really glad you brought up Carter Worth. I'm going to channel my inner Carter Worth for a second.
Love that.
Thinking about support and resistance levels, there's a lot of, I would say, traders that may not be as technical focused or inclined. And I get a lot of questions from investors saying, do you really believe in technical analysis? Here's my thought about support and resistance. It has nothing to do with lines on a chart. It has to do with the price at which buyers and sellers purchased an individual security. Think about Royal Caribbean. Prior to this June 15th break below this support level, every investor prior to Royal Caribbean, prior to June 15th, purchased this stock above $48, meaning you were a buyer above $48 if you bought the stock before June 15th. After June 15th, the stock that you bought is now substantially below your original cost basis. So you are now have a paper loss in your portfolio. Now think about that. You have a paper loss in your portfolio. Perhaps you have other stocks that are performing well. You have this one stock that's really underperforming. And after a few months of grinding it out, hoping it'll get back to break even, it does get back to your price level. Now, maybe you bought it at 50, maybe you bought it at 48, maybe you bought it at 60. But when you have a 50% rally in the underlying security, you might be saying to yourself, we're entering a bear market. This is possibly the best opportunity for me to get out at a small loss or perhaps at a scratch or break even. You might take that opportunity. And that is why prior support turns into new resistance, because buyers that were previously underwater have an opportunity to get out at break even. Many of them are going to take that. And that's when you see another flooding of selling. And I hope that makes sense to everyone. For those of you that are asking, why do support and resistance levels work? It's because of that psychology of price that you remember. And guess what? You remember what price you bought that stock at. And it has nothing to do with lines on a chart. So I hope that makes sense to everyone. If it does, please type 3 into the chat window.
That's so beautifully said. I love that. Borrowing that one.
Thank you. I will say those aren't my words. That's me channeling my inner Carter Worth. Now let's talk a little bit about actual individual opportunities. So we've talked about statistics of bear markets. We've talked about some of the things you look for in terms of skewing the risk reward back in your favor, because statistically speaking, it's a difficult trade to find short opportunities. How do you then further potentially put the opportunities more in your favor? So we talked about technicals, we talked about timing and risk reward. I'd like to talk a little bit about the fundamentals, because I think it's really important as well. I know some traders like to be purely technical, and there's nothing wrong with that. Like Carter Worth, he finds the really great opportunities. I just like to factor into also some fundamentals. I personally like to understand what a company does and why it might underperform in a bear market, or why I think perhaps it's overvalued and it's justified for it to be trading at a lower price. So I have a few things to kind of knock off as a checklist. You don't have to have all of them, but the more things that you have, the better. So one, I like to look at stocks that generally speaking have above average valuations. Now, there are many different ways that you can interpret that. And in reality, there are many ways to interpret that. You can look at average valuation in terms of the stock relative to its peers. For example, Hershey's. I'm looking at Hershey's because it's trading at a substantially higher valuation than any other of the stock in the consumer staple space. That's a good example of a stock trading at above average valuation. You can also look at above average valuations relative to the growth rate. I think Apple's a good example of this. Apple's trading at about 26, 27 times next year's earnings, yet it's only expecting to grow EPS by about 7 to 8% next year. That is substantially higher than most other stocks that are only expecting single-digit EPS growth trading at those types of valuations. Now, there are other factors that you have to consider, but that's just an example. And I'm not saying that Apple is necessarily overvalued, but it is something to look out for in terms of what is the expected growth rate and what is a reasonable valuation for that growth rate. I happen to think Apple is trading at too rich of a valuation given the expected growth rate. And lastly, you can also look at just the valuation of a stock relative to its own self, own history. Royal Caribbean happens to fit into that specific category for me. It's a stock that, generally speaking, trades at about 10 times EBITDA in terms of enterprise value. Right now, trading substantially higher than that, about 30, 35 times EBITDA in terms of enterprise value. And that's another example of rich valuations. So many different ways to skin that cat, but look for stocks that are trading in some way, shape, or form valuations above than what perhaps it should reasonably be trading at. That's one thing I typically look out for. The second thing I look for, and this is more so because of the rising interest rate environment that we're in, because if you think about what you're investing in a company, you're investing in the future cash flows or the future earnings of that specific company. And you have certain stocks that are today not profitable that are hoping to turn profitable in the next few years. And what you're really purchasing is that opportunity of that stock turning profitable in the next few years. But for stocks that are not profitable today, where you're basically valuing based on the present value of its future earnings, you have to discount that at a higher discount rate and a higher interest rate environment. So those are the types of stocks that tend to see the largest multiple contraction of valuations in a higher interest rate environment. So those are second things that I look out for. So specifically, companies that are not profitable that have these earnings that are expected to be profitable in the next few years. And the more earnings they expect in the future years, the more likely they are going to collapse at a faster rate in a rising interest rate environment. Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. Perfect. And lastly, and again, like I said, none of these in itself is a reason to necessarily short a market, short a specific stock. But the more of these things that you look out for, the more red flags there are, in my opinion, the better the opportunity. And Royal Caribbean meets this last criteria, which is high levels of debt with either low or negative cash flow. Meaning, this is a company that has expanded their debt facilities over the last few years. Royal Caribbean is a good example. They had about $18 billion of debt. Now they're about $27 billion of debt. So they've added about 50% on their books, $9 billion on a stock that is only trading at a $12 billion market cap. You know, that is a pretty heavily indebted company, and it's a generally heavily indebted industry. And given where they are in terms of high amounts of debt, they're not generating any free cash flow from operating. And the fact that they're not generating free cash flow means that it's going to be difficult for them to pay off that debt in a more uncertain environment. So those are some of the things that I generally look out for in stocks that are, from a fundamental perspective, in a bear market. Does that make sense? Please type 5 in this chat window if that makes sense to you. Perfect. Okay, so let's talk a little bit about how do you actually then potentially profit from these types of ideas that might come across. And we'll talk a little about how you can find ideas like the ones that I've said using our OptionsPlay tool. First of all, we've talked about at the beginning of the show that bear markets, not only are they from a directional perspective moving lower, they also have higher volatility. So Jess, you and I, we've done a lot of these over the past few weeks talking about option selling, right? That in a higher volatility environment that we are looking at right now, it favors option selling. You've looked at selling puts on quite a few different names. You've looked at selling call credit spreads on Apple. These are all types of strategies that you generally want to use in this type of higher volatility environment. We'll talk about some of the specific strategies here in 1 second. But it's important that in a bear market, there are opportunities to buy premium and buy puts and buy debit spreads. But statistically speaking, it's going to favor selling option strategies. So we'll talk about what those strategies are. The second thing that you want to look at in these types of markets, because markets move lower faster than they move higher, you tend to adjust your expiration dates a little shorter, meaning normally when you'd expect the stock to make a 10% move to the upside, perhaps you think that might take 2 months. That might only take 1 month to move to the downside. So you want to, generally speaking, adjust your expiration dates a little shorter in a more volatile bear market. Third thing, spreads are what you generally want to use in this type of market environment. So whether you're buying options, and Jess does a great job talking about strategy drivers, right? We talk about debit spreads where the strategy driver is the long option, and then in a credit spread, the strategy driver is the short option. In either one, whether you're buying an option or shorting an option, there are pros and cons to each one. When you're buying an option, it's expensive, especially in a bear market where volatility is really high. So when you trade a spread like a debit spread, that's going to help you offset the cost of buying that long put. But then when you're selling an option, you have negative risk to reward ratio, and you could potentially have an unlimited risk. And that's a downside of selling options. So another way that you can adjust that is using a credit spread, where you basically limit the risk that you take on a short option. So those are some of the ways that you can utilize options to help you navigate a volatile market. And lastly, arguably probably more important than anything else, is potentially scaling in and out of your trade as opposed to being all in or all out. This is something we'll talk about in terms of position sizing in a few minutes, but those are some of the things that you really want to look out for if you're trading a bear market, especially if this is your first time. Does that make sense, everyone? Please type 6 into the chat window if that makes sense to you. Perfect. Okay. So let's talk a little bit about how do you then find ideas in a bear market, right? We've talked a lot about theoretical, conceptual stuff. Let's actually put some meat on the bones and talk about how to find ideas. And this is really where I'm going to turn to the OptionsPlay platform. Now, most of you viewers here today are familiar with OptionsPlay. You are either a subscriber, you're a member, and I really appreciate all of your support for us to continue building out platforms like this. But if this is your first time, I'll show you how to access this platform at the end of this session. But on the platform, there are quite a few different ways that you can scan for bearish opportunities. The first and foremost is our Trade Ideas tab, which is on the very upper left-hand corner. It's the first thing that you see on your platform when you log in. And what you can do is you can filter these ideas based on the market. So right now, as you can see, the 1 month and 6 month trend of the broader markets is bearish. That helps me confirm my views. And for those of you that join our strategy sessions on Monday mornings to help you identify the direction of the market, Rick Benson, our chief market strategist, has been very clear that this week, the tone of the market has shifted. If you look at our daily play communication from this morning, we're now looking for rallies to sell. This helps you inform whether you should be looking for bullish or bearish opportunities in the market. So what I'm going to do is I'm going to use the filters, and I'm going to only look for bearish opportunities. I also happen to like to look for options that are either somewhat liquid or very liquid. So this is for those of you that are options traders, to be able to find ideas that are also going to be applicable for options. And when you apply that, you'll see that right now there's only 2 opportunities. But every single day you come back, you're going to see different opportunities. So one I was looking at here is Las Vegas Sands. You know, we recently took a short position here in Hilton. So similar type play here. A lot of these stocks are trading at pretty rich valuations because they're not profitable yet. We're not quite profitable yet. The margins have continued to be extremely low on some of these travel stocks, and hotels arguably has been the best category within the travel space, but clearly some downside. And we've seen Las Vegas Sands consistently trade against this $40 resistance level and failed to break out. So that's a good sign that this could potentially head back lower. So that's really how you can quickly identify bearish opportunities without having to build your own scanners and build your screeners. This does all of that for you. You just look for bearish opportunities. And then what you can do is you can use the trade tab, click on bearish, and now you have bearish option strategies that you can use. You can outright buy a put option, but like I said, the vertical spread here, the debit spread, is going to give you a better risk to reward in this type of high volatility environment. Or you can look at selling credit spreads as well. This automates finding the opportunities as well as helping you structure the options trade on the back of it. As you can see, I can find an idea, structure the options trade within a few seconds, and potentially click on the trade button to enter this trade for my broker. You can either do it by entering these legs into your broker's platform. You can even paper trade this in OptionsPlay by simply clicking on your portfolio and adding the position to a paper trading portfolio that you can now track and see how that position transforms over time. So that's something to look out for using the OptionsPlay platform. How many of you have used the trading tab here in OptionsPlay? Please type 1 into the chat window if you've used the Trade Ideas tab to find opportunities. Okay, I see a lot of ones. And for those of you that are new and maybe you haven't used it or maybe you've never looked at that trading tab, hopefully this helps you navigate that particular screen. Now, those are ideas that we've scanned for. But we also have another one that you may not be familiar with, which is under the watch list tab. We have a bearish momentum watch list. Now, the bearish momentum watch list is generally speaking for trend following ideas. These are stocks that are where the momentum is clearly bearish and everything is pointing to a move lower. So for those of you that have been following us, we've been short Boeing for quite some time here. We've continued to take a bearish position here in Boeing. And as you can see, it's starting to break below some support levels. This is likely to continue lower. So what we're looking for are stocks that recently turned bearish and have a likelihood of continuing lower. And you can just go through this list. And a lot of the discretionary stocks like Best Buy, Jess was talking about discretion being a category or a sector that could underperform in a bear market. This helps you identify some of those stocks. Now, this is out of 5,000 optionable securities. We've narrowed it down to 58 that are showing bearish opportunities. And this helps you narrow down the opportunities that you have to look at. You still have to do a little bit more work and a little bit more digging, but it narrows the universe substantially to a smaller universe that's far more applicable. And then look at industrials. We know industrials, a significant slowdown in industrials. Names like Caterpillar, Boeing, these are the names that might underperform. You also have some of these, as I talk about stocks that are not profitable, that have, trading at fairly high valuations, CrowdStrike. These are the types of stocks that are potentially at risk of turning lower. This is how you can identify them. And then using the OptionsPlay tool to find a structure, an options trade on the back of it. I'll talk a little bit about options trades for those of you that are new to options and what type of strategies you might want to use. But let's focus more right now on finding the opportunities. So you have trade ideas, and then you have our bearish momentum watch list. And then I want to show you another tool. This is in your OptionsPlay hub, which you can find if you click on the education and resources link here at the upper right-hand corner of your page. That will take you to the OptionsPlay hub. And within the hub, we have a credit spread opportunity report. This is for those of you that trade credit spreads. And you can find bearish credit spreads to sell in the broader markets. And what we have here is a report of credit spreads that collect a fair amount of the vertical width. Now, if you want to learn more about credit spreads, I have a whole video on this on YouTube. You can go and watch that. There was a deep dive into the strategy, walking you through the report. But that's another way that you can find opportunities. EWW is one of the credit spreads that we currently find in the markets. Altria, another bearish opportunity. This helps you identify stocks that are bearish, meaning from a directional perspective. So these are credit spreads that have a high statistical chance of profit. It also allows you to do so based on the directional view, and it filters for liquidity. So anything you see on our report already passes all of our stringent filters that we would normally use, that I can immediately go in and potentially trade. And all you have to do is click on the symbol, and it will actually populate the trade within OptionsPlay so that you can analyze it and decide whether it's a trade that you want to pursue or not. So if I click on that Altria trade, it will actually populate that trade in OptionsPlay so that I can view the risk to reward. I can look at the live premiums and be able to trade this potentially immediately. So here I can look at selling the 44.46 credit spread here on Altria. And as you can see here, this is an example of a bit of a rally here in a bearish trend. So this is the stock that's trending lower. It's got a bit of a rally here. That is the opportunity, in my opinion. Those are the rallies that we're looking for. So this report already scans for those rallies that we're talking about. It scans for liquidity. So as you can see, this is a stock that is very liquid based on our liquidity scans. And collects 73 cents on a $2 wide credit spread. That's just under 40% of the vertical width. So statistically speaking, I have another edge on this credit spread. So direction, liquidity, and statistical edge, that's what this report does. It does all three things for you, and you can find it using the OptionsPlay tool. It's available to everyone on the OptionsPlay platform by clicking on the credit spread opportunity report. So a lot of different ways that you can use our platform to find opportunities. And this is probably the most common question that I've gotten over the past week or so is, how do I find bearish ideas? And that's why we wanted to do this video, to walk you through how you can use our platform to find these types of potential opportunities. So a lot of different ways, but hopefully I covered a few here. So let's now jump into some of the option strategies. And Jess, we've been talking about these types of strategies over the past few weeks, but the first one, probably most commonly used right now in this type of environment, are credit spreads. You've recently sold a credit spread on Apple. Could you talk to us a little bit about kind of why you used a credit spread on Apple, why you use credit spreads in this type of market environment?
Yeah, so like you were saying, is the spiked implied volatility, and that happens on the call side and on the put side. And since this is technically a beginner session, I would love to define implied volatility. That's just the market's forecast of a likely movement in the underlying security in either direction. It's a extrinsic value component of an options premium that can inflate the price if there's a highly anticipated movement. Normally it happens pre-earnings. That's the best way in the way that we normally describe it, but it's also really inflated in high volatile times because with a market, just like Tony was saying, stocks tend to fall down the stairs and you climb back up. Same type of scenario. So there's that likelihood of movement, therefore it inflates prices. So a call credit spread, and the reason why I chose that one on Apple, one, I chose the credit spread side because of the inflated premium. It's an optimal to capitalize premium in that moment because it's expensive. And if something is very expensive, I prefer to sell at that moment, even though sometimes I'm told I have expensive taste. But Apple, for example, it really follows technical analysis to the T sometimes. And those levels are just, oh, so beautiful. So if you find a really, really key resistance level, that's that point, just like we were saying before, where I would take a short position. And what we mean by short position is a bearish view. And now you have to decide, am I going to take a sharp directional bearish view, which is what I would buy a put for, because that's when it's more profitable. And I even need a more sharp directional move in a high implied volatility environment, but that is likely because of the falling down the stairs analogy. However, with Apple, it's a darling, it's a fan favorite. They sell iPhones, they make money, and they just released a new iPhone. People are very excited about it. So that's always a risk with something like Apple, where it is absolutely a favorite and can drive a huge portion of the market. So something that is a credit spread, you actually profit not from a large directional move. You can have a sentiment in either direction. So in this case, bearish, but if it just stays just below my strike price, I'm still going to be at max profit, and I can experience volatility crush a little quicker and reach max profit as well. So that's why I chose it in that stance, and that's applicable to a lot of different securities. And that's where I think in bearish markets specifically, technical analysis is even more prevalent because it is those areas of support and resistance, otherwise supply and demand.
Yeah, so I do tend to find that credit spreads make a lot of sense in a bear market, because even if you are bad at picking stocks, if you will, right? Bad at picking bearish stocks, and the stock just sits there even though the markets are selling off, right? This is a type of strategy that will still profit in that type of market environment. And that's the benefit of a credit spread. There are trade-offs with that, right? Which is the fact that if the stock rallies, you're going to risk more than what you can potentially make. But all options or all trading strategies are based on trade-offs. It's a matter of what you prefer. And I think for a lot of traders who may not feel as confident in their ability to pick bearish stocks, credit spreads make some sense. Just as long as you can time it relatively well, you can be profitable in selling credit spreads, even if you're pretty bad, in my opinion, of picking bearish stocks. So that's one strategy that I think is a starting point for a bear market. Now, I do want to talk a little bit about hedging, right? And this is applying for whether you have an equity position you're looking to hedge, or you're just tactically, you have a bearish view, like Royal Caribbean. That's a stock that I have a bearish view on. I don't own the stock. I don't necessarily, I'm trying to hedge that stock. But the strategy for taking either a hedge or a tactical play in that specific security is the same, and it's using a debit spread. A debit spread is the strategy driver is that long put. So we all know that buying puts is the strategy that you could potentially use to take advantage of a move to the downside. But as you said before, implied volatilities are high, which means buying puts are really expensive. So one of the ways that you can offset the cost of buying that put is to sell a lower put. And when you do that, you're going to be able to reduce your risk and potentially make more. So debit spreads are a very common way to hedge or take a tactical bearish view on a security. And in OptionsPlay, for any time you click on the bearish tab, we will always show you the debit spread here on the right-hand side. And you'll see most of the time what you can potentially risk, $1,300 or so here in CrowdStrike versus the $2,700 that you can make if you are correct, is usually at least 2 to 1. So what you can potentially make is twice as large as what you are risking. And when the statistical probability of a bear market is skewed against you, you have to take trades, generally speaking, that have these positive risk reward ratios to offset that low statistical probability of being right on a bear market trade. Anything else to add from your perspective on a debit spread, Jessica?
No, I think you covered it. It's sharp directional move, and that's important to be cognizant of, but that's more likely in a downwards market than on the upside. So there's still ways to capitalize on that as well. And no, even on the, going back to the credit spreads, I'm sorry, you can even leave yourself room for the upside as well by the way that you choose your strike prices. So if it's slightly out of the money, you can still be profitable if it moves up a little, but the trade-off is a little bit of less premium. So there's ways to utilize that and take a little bit of less risk, but less risk, less reward.
Yeah, absolutely. So we've covered two strategies that I generally speaking would suggest for anyone who's perhaps starting out with options, trading, a bearish market, because both of those strategies have limited risk. You know exactly how much you can potentially lose if the trade goes completely 100% in the opposite direction that you expect it to. And it's important that you know that and are comfortable with that risk. So let's now talk a little bit about the deeper end of the pool. And I saw a question here asking about why straddles and strangles have the highest options play score. Well, it's because statistically speaking, short strangles and short straddles have the highest probability of profit and in the long run. And there's a few caveats to this, to what I'm about to say next. In the long run, it's one of the strategies that are most profitable in the long run. But the caveat is that in order to be profitable selling straddles and strangles, each straddle and strangle you sell has to account for a small percentage of your overall portfolio. So it's a strategy that generally speaking is only suitable for large portfolios, because many times if you sell a straddle and strangle, you might be taking a few $1,000s worth of risk. And if you only have a $10,000 portfolio, even taking a few $1,000s worth of risk in a single trade is simply too much. So this is really where, selling straddles and strangles is kind of like being the insurance company. You're basically selling premium, and you are the insurance company that if the market makes a big move, you have to pay out. And what you're trying to do is just sell a lot of small policies in a lot of different places and hoping that the market doesn't move as far in order for you to have to pay out. And statistically speaking, this is empirically shown over the past few decades. And this is not just for equities. FX, interest rates, currencies, equities. This strategy is the most profitable and actually has the shortest drawdown period of any other option strategy. And it's because you are the insurance company. You are constantly selling premium, and options consistently overstate the actual volatility or the actual risk that you're taking with short strangles. So hopefully that answers two questions in one. Why is short strangles and straddles the highest options play score? It's because statistically speaking, it is the strategy that has the highest probability of success, but also but there are caveats to that. So this is the deep end of the pool because this is a trade with unlimited risk, But if you have a short strangle, you can take a bearish view by simply skewing the deltas in your favor. So what you can do is you can sell maybe a 30 delta call and then sell a 15 delta put. So your net delta is that you're still short the markets, but you're short volatility and you're short theta on both sides. I don't quite have enough time to get into the nitty gritty of all of that. And we actually did a session last week with Tom Sosnoff from Tastyworks on this one specific strategy. If you want to go back and learn a little bit more, but this is the deeper end of the pool for those of you that have large portfolios trying to navigate a higher volatility environment. That favors option selling, and a short strangle is a pure short volatility, short directional play here. But like I said, not for everyone. It's really for those of you that have a larger portfolio. So with that, I want to wrap this up and talk a little bit about position sizing. I talked about before how important it is for if you're new to use limited risk strategies. It's even more important when you're trading in any type of market, not bull markets or bear markets specifically, but any market, that you control your losses, because you cannot control where the markets go. You can't control where the stocks are headed. You can't control valuations. You can't control the Fed. What you can control is how much risk you take. And if you want any shot at being profitable as a trader, the only way you have any shot at being profitable is if you make sure that you don't blow up your account. Because the second you blow up your account, guess what? Any shot at being profitable is completely off the table. And it only takes one bad mistake, one slip up to blow up your account. And for those of you that can relate to that, type 1 into the chat window if you've taken too large of a trade once, didn't go in your favor, and maybe got desperate and tried something else. And next thing you know, you've blown a substantially larger hole in your portfolio than you originally intended on. And you have months, if not years, to get yourself back to where you were. It only takes one slip up. So that's really what's the difficult part about trading. And guess what? There's an arguably easy way around that. Emotionally speaking, it's not easy, but from a process and strategy-wise perspective, really easy. And that's never exceeding 2% of your total account value on any given trade. And OptionsPlay has a tool designed to help you do exactly that. For those of you on the OptionsPlay platform, in the risk and investment calculator, we allow you to enter your portfolio defaults in the risk and investment calculator. We have this tool. You can adjust your defaults in your portfolio. And what you can do is you can select what your portfolio size is and what percentage of your account you're willing to risk per trade. I recommend that you never exceed 2%. And I have a whole video on why that's the case from the math perspective. Anything above 2%, statistically speaking, you're going to have a hard time when you have a string of losses to get yourself back to break even. So what you have to do is use the 2% rule and type in your portfolio value. I have $100,000 in mine. You can choose whatever dollar amount you want or whatever size of your portfolio. And when you use the OptionsPlay tool, no matter what stock you type in, whether you're looking at Royal Caribbean, whether you're looking at CrowdStrike, whether you're looking at a debit spread or a credit spread, doesn't matter. Use the risk and investment calculator and click on calculate, because it will then calculate the number of contracts you can purchase or sell where your max risk is going to be just shy of 2% of your $100,000 portfolio. So as you can see here, the three strategies that I have, the stock leg, the call leg, the debit spread, all have a max risk less than $2,000. So no matter what happens, even if the stock goes in the exact opposite that you expect it to, you will risk no more than 2% of your total account value. You still have 98% of your account intact to make your next trade. And you're less likely rather to make the mistake of saying, I've lost too much money, I'm getting desperate. And those are the times when we tend to make the worst mistakes. Emotionally speaking, when we're in a bear market, we're already stressed because investments that we bought from last year are underwater. We're not sure what to do. We make bad decisions sometimes when we're under stress. And that's one of the things that I want to address during this session is that, bear markets are not just about how to navigate, a market that's moving lower. It's also about how to navigate your emotions. And the best way to do so is to have a process. Jess and I have been very big advocates of showing people how to master your process. Having a process is what helps you overcome that emotional place that you go to where you make bad decisions. So hopefully this gives you some of the tools, some of the information that you need to better understand how bear markets are different from bull markets, how to find opportunities, and how to stay out of trouble from your positions. That covers a lot here today. We've covered a ton of information. So at this point, what I want to do is I want to take a pause. For those of you that have OptionsPlay or are a subscriber of OptionsPlay, I want to thank you for your support in helping us continue to do this week after week. You know, Jessica and I really enjoy doing these sessions of helping you better understand the markets, helping you understand your process so that you can be a better trader. But for those of you that are brand new, if you haven't used any of our tools before and you want to look at some of the things that we showed you here today, free 30-day trial available to you at optionsplay.com. You can point your phone at that QR code in the lower left corner to sign up for a free 30-day trial. You're going to get access to our OptionsPlay platform, what I just showed you, the platform to scan for ideas, that bearish momentum watch list, the credit spread report, and the instant strategies, and to use that risk and investment calculator. I think arguably the most important tool that we have on our platform is that risk and investment calculator. How many of you have used it? Type yes into the chat window if you've used it to help you stay out of trouble. And I know a lot of you have. And I want to know how many of you haven't used it also. Type no if you haven't used it, because if you haven't, go in there now, type in your portfolio value and use it every single time you place a trade, because that's going to help you stay out of trouble. That's going to help you stay out of blowing up your account. You know, Jess and I are here every single Thursday to help you master your process. The platform is there to help you find ideas. And Rick Benson, our chief market strategist, who we're going to have on next Thursday, he hosts a session every single Monday and sends out a research report at the beginning of the week to help you understand the broader picture. Should I be looking at bear opportunities, or should I look for bounces in the market? He helps you stay. He helps us, me and Jessica, stay on the right side of the market. So it's really important that you start off your week right with the bigger picture. OptionsPlay provides all of those things to you, and you can get a free 30-day trial at optionsplay.com. By pointing your phone at the QR code here in the lower left-hand corner. So I've covered a lot of things here today. I've done a lot of talking here. So what I'm going to do is I'm going to turn this over to you guys. We're going to try to answer some questions here before we run. I know I've gone a little over here in time, so I'm going to try to get through as many questions as possible and try to address some of your questions. So there's a chat window and a Q&A window. Please type your questions into the Q&A window, and Jessica and I will try to answer as many as we possibly can before we have to sign off.
Yes. I also tried to answer them throughout as well. So watch out.
Okay. Thank you for that. I appreciate that.
No
and Jess, if there anything jump out at you, please feel free to go ahead and jump in.
Sure. While I'm looking, do you want to address the stop loss and profit exits?
I don't see that. Okay. Can you explain how to put brackets for spreads? So, you know, most platforms don't support bracket orders for spreads. I trade on Thinkorswim, which is one of the few platforms that I'm aware of that does that. I believe Interactive Brokerage also offers that. But I actually have a video on YouTube where I show you how to put on bracket orders using the Thinkorswim platform. So dig into that. But basically what you're doing is you're putting a stop loss and a take profit, and whichever one triggers, it cancels the other. It's a simple one cancels the other order, but it's on a spread. Most brokerage firms don't support that, unfortunately.
Mm-hmm.
Luke is saying, how do you adjust a credit spread that moves against you? We talked about this a little bit with Rick and I a couple of weeks ago on our Daily Play Masterclass. You know, I'm in the camp that if a credit spread is moving against you, cut your losses and move on, because your directional view was wrong. There are some cases where if it blows through the long strike, where you can buy back the short strike and keep your long leg and hope that the stock continues to run in that direction. You know, especially if it's broken a major support and resistance level, that is the one adjustment that I would advocate for, if and only if you believe that the broken support or resistance has room to run. Helen's asking, what technical indicators are used to provide the support and resistance in OptionsPlay? Helen, we don't use any support. We don't use any technical indicators. This was a proprietary tool that we built out of trading, as traders years and years ago. It actually leverages volume on price. We usually are used to plotting volume on time, but volume on time I find is really useless in many cases. But if you plot volume on price, meaning how many shares was traded at a specific price, gives you a lot more insights into where support or resistance, or rather where demand and supply lies. So I'll tell you that, but I can't tell you any more than that. But there are a lot of platforms that actually support volume on price. Thinkorswim, TradingView, they all support that. If you want to take a look at it, you can see what I mean. Lance is asking a great question. For a bear market, do you look for stocks that have, when he says high or low strength, I think he's referring to, and there was another question before asking, what does the strength number mean on our platform? The strength is referring to relative strength. So it's looking at the stock relative to the market. Stocks with the 1 are the worst performing stocks in the market, and stocks with the 10 are the best performing stocks in the market. And remember, strength is not directional, because if the markets are down 20%, perhaps the best performing stock is a stock that hasn't moved, right? Meaning the markets are down 20%, but this stock hasn't lost any value. So it has strong relative strength. So remember that strength and direction are two separate things. So the question is, do you look for strong strength or weak strength in a bear market? I advocate that you can look for both. Weak strength tells you these are the weakest stocks. They have an opportunity to continue moving lower. And the strong stocks, those are the ones that have potentially the highest chance of making the big moves to the downside. Weak stocks may not have as much room to the downside versus the strongest stocks. So it really depends on kind of your risk profile. I tend to look for sometimes strong stocks, like United Health is a good example of this. Hershey Kisses, which we took a short position here a couple of weeks ago, some of the strongest stocks in the market. But those strong stocks have some of the biggest opportunities to make big moves to the downside. So I advocate you can look at both. I don't think just one or the other.
I agree. There's a process, and I get a lot of questions too about technical analysis. Where do I start? There's indicators that go in different categories. You shouldn't rely on one thing. You just look at what you like. Definitely not one specifically, but it's always an indication for further investigation, and then you layer on top of that. But that's also the purpose of why we give you the strength and the trend. You don't have to do that if you don't want to, and that's the purpose of the tool.
Yeah, and one I will point us to one indicator that we do use heavily here at OptionsPlay, which is the Ichimoku cloud. And we have a YouTube video just on that one indicator alone. Rick uses it, I use it, Rick, Jessica, you've been using it for years. It is a complicated indicator at first. It looks messy, it looks complicated, but once you break it down into its component parts, it can make a lot of sense. And I do encourage, for those of you that are interested in better understanding our research and how we're looking at the markets, to do a little bit of research into Ichimoku Cloud. We have a session on it on our YouTube channel. There are plenty of other ones that you can watch as well, but it's a good starting point, for a lot of technical traders. When it comes to credit spreads, why is the optimal premium 33%? The optimal premium is not 33%. The minimum premium is 33%. The optimal premium is more than 33%. Basically, what you're doing is that when you're collecting more than 33%, you're just skewing the risk to reward in your favor. At 33%, you have a 2-to-1 risk to reward ratio. At 40%, you have a 1.5-to-1 risk to reward ratio. So the higher the premium you get, the better the risk to reward ratio gets in your favor. And that's why we scan for ones that have at least 33%. So many questions. I will try to get to a few more before we sign off here today. Nadia is asking, do you use PE ratio? So I use PE ratio as a good gauge for of valuations. And I look at it in two different ways. I look at it not only relative to the peers in the space, but also relative to itself. But I don't look at PE in price to earnings. They look at price to next year's earnings. And that's an important distinction because it gives you a sense for what the market is expecting that stock to do. It also factors into the potential growth of the stock over the next year. So that's one that I look at. So it is one that I heavily look at, but there is one industry that you don't use PE for, and that's financial firms. You don't generally speaking, use PE for financial firms. That's the only sector where PE is not generally used. Jess, I will let you take the last question before we sign off.
Oh, you know, I hate it when you do that. I've been scrolling through the chat. There's so many 1s and 6s to find it.
You have a lot of choices today.
There is some here. You know, there is actually a lot on the platform, which is normally not a question I would grab, but I'm going to grab that one. If you do not have access to the platform and you do create a free trial for 30 days, you get literally access to everything. I saw a question on there also on trade ideas. So there's a couple of ways that you get those. So we took you through a lot of methods that are found on the platform that you can utilize yourself, like the reports or via the tool on the left-hand side of the screen. But you also get a daily play every day that's going to be in line with the macro research that Rick puts out. So it gives you an overall market sentiment. And then that's going to have some reasoning behind it as well, which is what a great way to learn. This is how we're positioning a trade. Here's why we are positioning that trade. And here's the overall macro view as well. And you're going to get that every single day, inclusive of when we close that trade. And sometimes it's partial close. Sometimes there's rolls, there's things of that nature. So it's a great way just to even learn by having access to that information. We want to make sure you have a 30-day trial because there is a lot of information and we want you to get the most value out of it. And then of course we have those educational sessions, and that's extremely important because just like I said, with the daily play, getting that view, we want to make sure you understand it. Options can be complex, and Tony and I honestly became friends because we both like options and like explaining it, and therefore we work together now, and we want to bring this information to our valuable members and everyone who wants to trade options. So hopefully that answers all of the platform questions that I came across.
Well, thank you so much. I could not have said that better myself. But to wrap this up, again, I hope that this was helpful in giving you some basic information about bear markets, how to look for it from a timing perspective, how to look for opportunities to scan and kind of do a litmus test on the specific companies that you might have ideas on, and then how to structure an options trade to protect yourself on the downside so that you have limited risk, but also have that profit potential. There's a lot more information that we have here at OptionsPlay. You can please look at our YouTube channel. Jessica and I recently just hosted a session a couple of weeks ago on bear market strategies if you want to learn more. But we are here every single week, like I said, to help you master your process so that you have a better understanding of best practices, so you have a better shot of sticking to your trading plan, which is arguably the most important thing for every investor. So with that, thank you so much. Thank you, Jessica. Thank you everyone for joining us from all around the world. And I will send you both the recording and the slides after we finish here today. And I look forward to many of you that are joining us for the first time on our next session next week with Rick Benson, our chief market strategist. We're going to dive into the markets and talk about specific ideas, sectors, and the broader markets. With that, thank you so much and have a great trading day.
Thanks, everyone.